Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, Warren Buffett is hoarding cash. We're going to show you exactly why, and you're probably going to want to as well. Let's dive in.
Trade Genius.
Bob, before we get into today's video, I gotta say we've been having a lot of shout outs. Kudos to you. We've had some great calls, but as you guys can see here, a lot of happy customers in the chat rooms. You guys can be there too. Head over to tradegenius.co and sign up. But Bob, some of these calls, Wolf, these yield max plays, I mean, they're just doing outstanding for these folks.
Yeah, and one more too, Phil. You've been calling out some lotto picks that have been paying out extraordinary gains. This is the time, guys, when all the crazies are out now. We have short squeezes, we have Bitcoin miners and proxies moving, and these yield max products. We have more coming out that are going to pay dividends tomorrow, 70 to 80% annualized, guys. So come check us out, tradelikeagenius.com. We got to make hay while the sun shines, because after you listen to this video, you might want to be buying a bigger barn. It takes us next slide, Phil. This is the Buffett indicator. And the reason why I bring this out is because people will tell you today, we're in a new world. But before we got into this new world, we had the dot-com bubble that took us to 150% of GDP. Buffett says over 120% of GDP, market's overvalued, back to 80, it's undervalued. So we shot up to 150%. We made a low, which got to a point where people thought it was undervalued enough. And then the great financial crisis hit, and GDP was only at 100% of GDP stock market valuation. And we dumped all the way down to where it was really, really undervalued market. And of course, they bid it up, Phil, for the next 10 years pretty aggressively. And then COVID hit, which gave us a spike low back down to about 100%. And then we haven't looked back. We're at 200% of GDP now. So the market is grotesquely overvalued. And there's only really two ways really out of it. Market, either inflation rips and causes a fake GDP boost to bring this in line, where the stock market doesn't move, but basically GDP rises because it's rising based on a fake number of inflation. Or we go into deflation, which is more likely, and this market can sell off 60% from its high to get back, and maybe even more. It could go down to 60% of GDP, which would bring us down maybe 70%, and you get a 1929 kind of crash, Phil. So people that tell you, oh, this never changes, the anomaly is really the last 12 to 15 years. That's the anomaly. And I think we're coming to the end of centralized banking. You're starting to see a lot of noise in that arena. And I think it's going to cause a massive market reset, because we have demographics going against us, unsustainable debt. And if this dollar takes off, Phil, because of debt repudiation, it's going to devastate the stock markets. I'll throw it back to you.
Yeah, and like you said, we're kind of in a new world in terms of how much liquidity is in the system. So, and you can see that reflected in Buffett's indicator, how it just keeps growing and growing, especially in the last decade. But as we've been repeatedly pointing out, all of that stimulus has basically prevented the regular cycle where we have periodic recessions that happen on average every 6 years or so from happening. And the result of that, you think, well, why don't they just always do that and we never have a recession? Well, that's because you avoid things like inflation. And, that's a very sticky point now. And it's hard to get down. Now, they're getting inflation growth down, but overall, the inflation is still not anywhere near the levels we were dealing with in terms of prices of things, right? Aggregate inflation is up 20-30% on a lot of things from before COVID. So ultimately, I think, the Fed, without saying it, but, they're going to be okay with some deflation. Buffett, I think, is also realizing that in terms of the business cycle, if you look at unemployment rate and things like that creeping up, we're due for a pullback. So like Bob was saying, I think once we see a pullback, and I think in this situation, we will see this thing get below 120%. And this metric in in blue is very tied to the price of the S&P 500. So you can imagine if this goes back down below that 120 level, where the S&P 500 is going to be, and that's going to rival a lot of what we've been saying, which is back to, COVID levels, right? Pre-COVID levels on a lot of things. We have actually had stocks already round trip the COVID levels. A lot of stocks haven't yet. And so I think we're going to see that in a broader sense. I think the bubble in AI and all of that stuff is going to come way down. I think NVIDIA is going to be the biggest Eiffel Tower chart you've ever seen, so that sort of thing, that reset is totally normal. But a lot of recent investors, newer investors, the millennial generation, they really don't grasp what it's like to go through something like an '08 and potentially something longer than '08. '08, from the crash to the low and then the response with the stimulus because of the systemic risk to the entire global banking system basically truncated how long that was going to play out. But, in this situation, if they're going to try to walk this down and things don't break, this could turn into an 18 to 24 month down cycle. And that's where you're going to start to see Buffett at the end of 2025, perhaps into 2026, start talking about how he's finding value in the market again. And I bet your bottom dollar, you're going to see his metric below 120 in that situation. Who knows? Maybe it gets back down to his more preferable levels down there, below 100, between 80 and 100%.
Well, one thing, we're going to have to be really, really careful because we're really coming up to the last of the undervalues are getting bid. The small caps are getting bid now. Yep. Eagle weight's getting bid now. Yep. Bitcoin's doing its pop. We're in a liquidity upcycle. But once that all plays itself out, then you're gonna have a situation where there's nowhere left to hide. And then once he starts cutting, it's going to give big money excuse to shift everything over to the bond market. And then you're going to start seeing a big sell-off. Remember, when this thing starts to go, deflation is harder to beat than inflation. They'll tell you that they can beat it, but once people get in the mindset of not spending, it's hard to get them out of that mindset. Look at Japan for 21 years. And I tell you one other thing too, the boomers are carrying right now the economy because they're flush with this 5% money and their portfolios look good. But I guarantee you start seeing 10, 15, 20% correction in their portfolio that they have to live on the rest of their life. They're going to start pulling back hard. And then it's just going to exacerbate everything. So when this thing goes, it's going to go. And anybody that's telling you on social media that they got this thing wired, they don't know anything. And once this dollar turns up from debt repudiation, then it's all bets are off because we saw just a little whiff of it and we saw what it did to the market. So once it really takes hold, goodbye. And people are looking at the wrong thing, Phil. Everybody's looking for the dollar to crash. They should absolutely worry about the dollar going parabolic. And with that, that's all I have to say today, Phil.
All right, guys, let us know your thoughts in the comments below. As Bob was saying, check out our stuff over at tradegenius.co. There's a lot of opportunity coming, especially when this market goes into bear mode. You'll still be able to extract dollars out of this market. We can show you how. We'll see you guys on the next video. Take care.
Trade Genius.